In 1887, a market woman in Oaxaca named Petra Jimenez started every Monday morning with a single basket of herbs she had grown herself. By the time she died in 1931, she owned 3 market stalls, a house with no mortgage, and had put 4 children through school in a country where most families could not read. Nobody wrote about her. No bank financed her. No government program helped her. The method she used is number 12 on this list, and you can start it with less than $20. Number 8 was practiced by over 40 million Latin Americans for centuries before any foreign bank ever opened a branch on the continent, and it outperforms most modern savings accounts when you account for fees. And number 1 built more generational wealth in Latin America between 1500 and 1900 than every stock market combined. Yet it was systematically dismantled by governments who understood exactly how powerful it was. These 20 methods were not secrets. They were common knowledge, the kind of thing your grandmother told you while she worked. The kind of knowledge that got passed down at kitchen tables and market stalls and harvest festivals before someone decided ordinary people should not know how money actually worked. Before we start, hit that subscribe button, because what you are about to learn is worth more than any financial advisor will tell you for free. Number 20, the tianguis cycle. Long before any department store opened in Latin America, commerce ran on a rotating market system that dated back to pre-Aztec civilization. Every town in Mesoamerica was assigned a different market day. Monday in one village, Wednesday in the next, Friday in the largest town of the region. A skilled trader would travel the full circuit, buying in one market and selling in the next, arbitraging the price difference between what a farmer needed to unload and what a craftsman was willing to pay. In 1790, a successful tianguis trader in the Valley of Mexico could move the equivalent of $400 in today's money across a single week's circuit with an initial investment of perhaps $15 in goods. The margins were real because the knowledge was local. You knew which village had too many chilies and which one was desperate for rope. Your grandmother did not wait for buyers to come to her. She knew where the demand was before the demand knew it needed her. The tianguis still operates across Mexico, Guatemala, and Peru. The principle has not changed in 3,000 years. Information about where prices differ is still the most valuable commodity in any market. Number 19, the arrieros. Before railroads reached Latin America's interior, which in most countries meant before 1880 at the earliest, the entire economy moved on the backs of mules. The arriero, the muleteer, was not just a transport worker. He was the internet of the colonial and early republican economy. He knew what goods were scarce in Medellin because he had just come from Bogotá. He knew the road to Potosi was closed because he had turned back from it last month. Families that owned even 3 or 4 mules and controlled a trade route between 2 cities could earn the equivalent of a skilled craftsman's annual wage in a single month during harvest season. In 1850, a muleteer operating between the coffee-growing highlands of Antioquia and the port of Honda in Colombia earned roughly 60 pesos per round trip at a time when a factory worker earned 4 pesos a month. The arrieros did not just move goods. They moved prices, news, and opportunity. Your great-great-grandfather understood that controlling the path between production and market was worth more than either end of the transaction. Number 18, the pulperia. In colonial and republican Latin America, the pulperia was the corner store, the bank, the pharmacy, and the social network all in one room. The pulpero, the person who ran it, extended credit to neighbors, exchanged agricultural surplus for manufactured goods, and operated as an informal exchange point between the cash economy and the barter economy. What made this financially powerful was the ledger. A skilled pulpero maintained detailed accounts of who owed what harvests were coming, and which families were reliable payers. In 1870, Buenos Aires, a well-run pulperia on the outskirts of the city, generated net margins of 25 to 35% on goods sold, plus interest on informal credit, plus commission on money exchanged for travelers. The pulpero, who served a neighborhood of 200 families, was often the wealthiest person in that neighborhood, not because he had started with capital, but because he had started with trust and a notebook. Modern convenience stores operate on a 15 to 20% margin. Your ancestors' corner store beat them by knowing the customers personally. Number 17. Milpa intercropping as a financial system. The milpa, the traditional Mesoamerican practice of planting corn, beans, and squash together in the same plot, was not just agriculture. It was a diversified financial portfolio growing in the ground. Corn provided calories and could be stored for 2 years without spoiling. Beans fixed nitrogen in the soil and provided protein that reduced the need to purchase meat. Squash suppressed weeds, reducing labor costs, and provided a fast-maturing crop that could be sold at market within 60 days of planting. In 1920, a Yucatan family farming a single hectare of milpa produced the equivalent of $180 worth of food in today's dollars, while spending less than $12 on inputs. The same hectare planted with a single cash crop in the modern style requires $80 in fertilizer alone, because the soil no longer feeds itself. Your grandmother's garden was not primitive. It was a self-sustaining financial engine that agribusiness companies have spent a century trying to replace with something that costs more and earns less. Number 16. Seed banking. Every farming family in pre-industrial Latin America maintained a seed reserve that functioned exactly like a savings account, except the interest was biological. You planted 100 seeds, harvested 1,000, ate or sold 700, and saved 300 for next season. That 300 was your capital, your insurance policy, and your trading currency simultaneously. In drought years, families with deep seed banks could sell planting stock to neighbors who had lost their reserves. In 1910, during the chaos of the Mexican Revolution, families in Puebla and Tlaxcala who maintained diverse seed collections and the knowledge of when and how to plant them survived economic disruption that wiped out families who depended on purchased inputs. The seed was not just food, it was sovereignty. Multinational seed companies understood this perfectly when they began patenting plant varieties in the 1970s and 1980s. A farmer who saves seeds owes nothing to anyone. A farmer who buys seeds every year is a permanent customer. Your grandparents' pantry shelf of seed jars was not nostalgia. It was financial independence measured in grams. Number 15. The solar economy. Latin American households traditionally operated what researchers now call a solar, a shared courtyard surrounded by multiple family dwellings. What economists later understood is that the solar was a financial structure disguised as an architectural one. Multiple family units sharing walls, a well, a kitchen fire, and childcare reduced per household costs by 30 to 40% compared to isolated nuclear families. In 1930s Mexico City, a solar housing 4 related families in what appeared to be crowded conditions was actually accumulating capital at 4 times the rate of a single-family household earning the same income. The first family paid down the property. The second saved for a small business. The third educated the children. The fourth maintained the infrastructure. Every resource was used twice before it left the system. Modern personal finance gurus sell the same concept as house hacking and charge $300 for a course about it. Your grandmother's family did it instinctively for generations. Here is where things get interesting. The methods so far have been about spending less and surviving more efficiently. The next batch is about making money grow. And this is where Latin America's working class had financial knowledge that foreign banks and colonial tax systems spent decades trying to suppress, discredit, and replace. Because the truth is, ordinary Latin Americans in the 18th and 19th centuries understood collective capital, compound return, and long-term asset accumulation better than most modern financial advisors give them credit for. Number 14, the tanda. This is possibly the most elegant financial invention in the history of Latin America, and it required no banker, no contract, and no government. A group of 10 to 20 people, neighbors, co-workers, market vendors, each contributed a fixed amount weekly or monthly. Each week, one member received the entire pot. By the end of the cycle, everyone had received exactly what they put in, but each person had received it all at once, as a lump sum, at a moment when they needed it for a major purchase or investment. In 1950, Mexico City, tanda groups among market vendors routinely funded the opening of new stalls, the purchase of sewing machines, or the down payment on a room to rent out. The financial mathematics are identical to a zero-interest loan. The social mathematics are more powerful. The pressure to contribute was not legal, it was communal, and default rates in traditional tanda networks were lower than most modern credit card portfolios. Today, tandas still operate across Latin America and in Latin immigrant communities in the United States. Your grandmother did not need a credit score. She needed a reputation. Number 13, lavaderos and river gold. From Choco in Colombia, to the rivers of Minas Gerais in Brazil, to the streams of highland Bolivia, small-scale gold and silver panning was a genuine secondary income stream for rural families well into the 20th century. This was not mining in the industrial sense. It was systematic, patient work, washing river sediment on Saturday afternoons and selling whatever gold dust accumulated over the month to local traders. In 1920s Colombia's Choco region, a family of 4 working a known stretch of river 1 day per week could supplement their agricultural income by 15 to 20% annually. The capital investment was a wooden baton, a shallow pan, and knowledge of which river bends accumulated sediment. The knowledge of where to work was inherited, passed from parent to child the way a recipe is passed down, and it stayed in families for generations. It was not a way to get rich. It was a way to have a reserve of real money that no inflation could touch. Number 12. The market stall inheritance system. In traditional Latin American markets, a good market position, a corner spot in a covered mercado, a stall facing the main entrance, a location near the food vendors, was worth money. Real money. Your grandmother did not just sell at the market. She owned her position in it, and that position could be transferred, rented, subdivided, or used as collateral in a community lending arrangement. In 1940, Mexico City's Mercado de la Merced, a premium corner stall position, changed hands for the equivalent of $2,000 in today's dollars. Purchased not through any legal mechanism, but through community recognition and social agreement. The woman who held that position and worked it for 30 years, like Petra Jimenez in Oaxaca, was not just a vendor. She was a business owner with a depreciating asset that she managed better than most people manage a stock portfolio. The informal economy was not informal because it lacked structure. It was informal because the structure belonged to the people who built it, not to institutions. Number 11. The compadrazgo lending network. The compadre system, the network of ritual kinship created through baptisms, weddings, and quinceañeras, was Latin America's version of a business network with built-in credit mechanisms. When you named someone the godfather of your child, you were entering a formal reciprocal economic relationship. Compadres were expected to lend money at no interest in emergencies, to provide labor without payment during harvest, and to prioritize each other as suppliers and customers. In a 1950s Mexican village study, researchers found that the average family had active compadrazgo relationships with 12 to 18 other families, creating an informal credit and labor network worth the equivalent of $400 to $600 per year in monetary terms. The system worked because default meant social death, not just financial loss. Banks replaced this with interest, contracts, and credit scores. Your grandmother replaced it with relationships, obligations, and trust. The math still favors her model. Number 10. Medicinal plant trading. Before pharmaceutical companies, before pharmacies, before even most hospitals reached rural Latin America, the person in every community who understood plants was the person with financial independence. Curanderas, herbalists, and midwives charged for their knowledge in goods, labor, and eventually cash. A skilled herbalist in 1900 Oaxaca who knew the timing, preparation, and dosage of 50 to 100 medicinal plants was functionally running a healthcare practice with zero overhead and infinite inventory because the inventory grew back every season. More importantly, the knowledge was proprietary. It could not be easily replicated by a neighbor without years of apprenticeship. In modern economic terms, this was intellectual property with the subscription model. People needed the herbalist repeatedly, not just once. Today, the global market for medicinal plants derived from traditional Latin American knowledge is worth over $2 billion annually. Almost none of that value flows back to the communities that developed the knowledge over centuries. Your great-grandmother's notebook of plant remedies was not superstition. It was a business with defensible margins and zero competitors. Number 9. The informal water rights system. In arid regions of Mexico, Peru, Bolivia, and Chile, water was the scarcest and most valuable resource. Communities developed sophisticated water-sharing systems, acequias, canales, and informal rotation agreements that determined who irrigated when and for how long. Families who had contributed labor to build or maintain the irrigation infrastructure held water rights proportional to their investment, and those rights could be sold, traded, or rented during dry years. In 1890s Cochabamba Valley, Bolivia, a family with strong water rights in a productive acequia system could earn the equivalent of 30 to 40% of their annual agricultural income simply by renting their water allocation to neighbors during peak demand periods. Water rights in modern California sell for up to $2,500 per acre-foot. Your ancestor understood that owning the infrastructure of survival gave you permanent leverage over those who did not. Number 8. The rifa. Before lotteries were nationalized and before insurance companies arrived in Latin America, communities invented their own risk pooling and capital generation mechanisms through the rifa, the community lottery. A family that needed to raise capital for a major purchase would offer a valuable item as the prize: a cow, a sewing machine, a piece of land, a month's labor. They sold numbered tickets at a price designed to raise more than the item's value. 20 people paid 2 pesos each for a cow worth 30 pesos. The ticket seller raised 40 pesos, bought the cow for 20, and donated it as the prize. The net was 20 pesos in capital, the equivalent of 2 weeks' wages for a skilled worker, raised in an afternoon from neighbors who felt they were participating in an opportunity rather than making a donation. Generations of Latin American families funded small businesses, tools, and property improvements through rifas. Modern crowdfunding platforms operate on an identical psychological mechanism and charge a 5% platform fee for the privilege. Your grandmother ran hers for free. Number 7. Making and selling fermented products. Pulque in Mexico, chicha in the Andes, tepache in Central America, guarapo in Colombia and Cuba, fermented beverages made from local agricultural products were the cottage industry that ran parallel to every other economic activity in Latin American history. The economics were remarkable. The raw materials, overripe fruit, cactus sap, fermented grain, cost almost nothing because they were considered agricultural waste or surplus. The production required minimal equipment and knowledge that passed easily from mother to daughter. A woman in 1920 Jalisco, producing pulque from her backyard maguey plants and selling it locally, earned a supplementary income equivalent to a full week of agricultural wages for every week she produced. This was not an accident. Fermented beverage production was one of the most reliable small-scale income generators in pre-industrial Latin America, precisely because the raw materials were free, the process was simple, and the demand was constant. Governments eventually taxed and licensed production, not because they cared about public health, but because they could not control the economic independence it generated. Number 6. The bordado and artisan export system. Spanish colonial trade created an unexpected opportunity that persisted for centuries. European demand for Latin American textiles, ceramics, lacquerwork, and embroidery was real and paying. Families in Teotitlan del Valle in Oaxaca, in Tonalá in Jalisco, in Cajamarca in Peru developed regional craft specializations that functioned as export industries operated entirely from the household level. In 1910, a Zapotec weaving family in Oaxaca producing wool textiles for the Mexico City and export market could earn 3 to 4 times the income of a comparable agricultural family because they were selling knowledge and skill embodied in an object, not just raw labor or raw materials. The margin was in the making, not in the having. Today, Oaxacan textiles sell for $300 to $800 apiece in galleries in New York and Los Angeles. The families in the villages still make them. The money still stops somewhere in between. Your great-grandmother's loom was not a craft. It was a manufacturing facility she owned outright. Number 5. The Fletero Network. Before trucking, before railroads reached the countryside, and before even reliable roads connected most of Latin America's interior, informal transport entrepreneurs called fleteros operated small cargo networks using mules, carts, and boats. The fletero who owned 2 mules and knew every back road between 2 commercial towns was running a logistics business with no formal registration, no insurance, and no competition from anyone with more capital, because the capital requirement, knowing the routes, knowing the customers, knowing the timing of harvests and fairs, could not be purchased. It had to be accumulated over years. In 1880, Antioquia, a fletero family operating between the mining region and the market town of Rio Negro, earned roughly twice the income of a skilled mine worker, while maintaining the independence of being their own employer. The logistics industry in Latin America today is worth over $400 billion annually. It started with your great-great-grandfather and 2 borrowed mules and a knowledge of roads nobody had mapped. Number 4. Community construction labor exchange. The Minga in the Andes, the Tequio in Mexico, the Convite in Central America, these were not charity. They were a sophisticated labor exchange system in which every family's construction, harvest, and infrastructure needs were met by collective effort, and every family that benefited was obligated to contribute equivalent labor to others. The financial math was elegant. If 20 families each needed 3 days of intensive labor to build a house, and each contributed 3 days to every other family's house, the total labor moved through the network was 60 days per family, the equivalent of hiring labor for 2 months at market rates. No money changed hands, but the economic value created for each family was identical to receiving a $600 gift. Families that participated fully in these networks built houses, granaries, and infrastructure they could never have financed individually. The network was the capital. Modern co-housing movements and labor-sharing platforms are attempting to recreate this at scale and calling it innovation. Your ancestors called it being a good neighbor. Number 3. The small-scale lending circle with fair terms. Before international banks arrived with compound interest and foreclosure clauses, local lending in Latin American communities operated through a system of known individuals who extended credit at terms negotiated face-to-face with someone who lived on your street. The prestamista who operated within a community was not a predator, or rather, the ones who survived long-term were not, because a lender whose borrowers defaulted into poverty lost both their capital and their social standing. Effective community lenders charged rates of 1 to 3% monthly, high by today's standards, but designed around agricultural cycles and harvest timing rather than fixed payment schedules that ignored crop failures. In 1930, Peru, community lending circles in Ayacucho region enabled small businesses, land purchases, and equipment investments in communities with no access to formal banking. The lender who built a reputation for flexibility during bad harvests had a waiting list of borrowers. The moral of the economics is simple. Money lent at rates the borrower can survive multiplies. Money lent at rates that extract everything does not come back. Number 2. The trade in knowledge. Education in pre-industrial Latin America was scarce enough that anyone who could read and write possessed a commercially valuable skill in every community. The literate person who wrote letters for illiterate neighbors, who read government documents and translated their implications, who drafted contracts and wills and complaints to authorities, was performing a service with zero marginal cost and constant demand. In 1880, an Andean woman who had learned to read from a nun's school and who offered letter-writing services in the Sunday market outside a provincial church could earn the equivalent of 2 days' agricultural wages in a single morning. The service required no equipment, no inventory, and no capital, only knowledge. As literacy spread through the 20th century, the premium shifted to those who understood law, accounting, and bureaucratic procedure. But the fundamental principle never changed. In every era of Latin American history, the person who understood how the formal system worked and could translate that understanding for people who did not possess an income-generating asset that cost nothing to store and nothing to transport. Number 1. Communal land ownership. This is the method that built more wealth for more ordinary Latin American families over more generations than any other item on this list. And it is the one that was most systematically dismantled. Before the late 19th and 20th century land reform programs that privatized communal holdings, Mexico's attack on ejido lands under Diaz in the 1880s, similar processes across the Andes and Central America, vast numbers of indigenous and mestizo communities held land collectively under systems where families had the right to use specific plots, but the land itself could not be sold, seized for debt, or concentrated into large holdings. What this created was a financial flaw that could not be removed by individual failure. A family that had a terrible harvest, fell into debt, or suffered a crisis could not lose their access to land because the land belonged to the community, not to an individual who could default on a loan. The 1992 reform of Mexico's ejido laws, which allowed communal land to be privatized and sold for the first time in modern history, preceded the single largest wave of rural-to-urban migration the country had ever seen. The two events were not a coincidence. Your ancestors understood something that took economists another century to prove. When the ground under you cannot be taken away, you can take risks, build slowly, and endure bad years without catastrophe. Every financial trick on this list, the tanda, the tequio, the tianguis, the knowledge traded at Sunday markets, funneled toward this single outcome. Not a bigger house, not a fancier life. Ground that belongs to the family and cannot be taken. Land your children inherit without a mortgage attached. The day that land was secured was the day generational wealth began. The reformers who dismantled these systems called it modernization. The families who lost their communal land called it what it was. Now you know what they had. The question is what you will build with that knowledge.